Good day, class. Welcome to the second session. In this session, we will briefly look at how to analyze the basic elements of a balance sheet. A balance sheet is a statement of financial position of a business at a specific point in time. It is usually at the end of the month or year. You can determine the current financial health of a business through analyzing and reviewing a balance sheet. At any given point, assets should be equal to liability plus capital, which is why this document is called a balance sheet. Assets are the resources that belong to the company. They are tangible and intangible assets. Tangible assets are the assets that you can touch or see, which could be vehicles, equipment, and buildings. Intangible assets include cash, debtors, stock of goods, land, and equipment. Liabilities are obligations of the company. They are the amounts the business owes to others as of the balance sheet date. Money received in advance of actually earning the money is also considered a liability. Capital is the monetary value of the part of the business which belongs to the proprietor. Assets, liabilities, and capital are the three main components of the accounting equation. The balance sheet is based off the accounting equation. It is the formal representation of the equation. Assets are normally listed on the left-hand side in the balance sheet. Capital is entered on the right-hand side, and liabilities are entered on the left-hand side. The balance sheet heading contains the name of the company, the title of the statement, and the date of the statement. Entries in the balance sheet are made from transfers from the trial balance. There are two basic formats for a balance sheet, which are the horizontal and the vertical form. In the horizontal form, the major categories are presented side by side, whereas the vertical form has them stacked on top of each other. Let us briefly look at the balance sheet headings, which include fixed assets, current assets, liabilities, and capital. Fixed assets are items bought in the business, not for resale, but to be used over a period of several years, which could include machinery, buildings, and furniture. Current assets are assets in the business which are used up and changed daily in the normal operation of the business, which could include stock of goods for sale, debtors, and business cash. Liability accounts are divided into two categories, which are current liabilities and long-term liabilities. Current liabilities represent money which the business owes and is obligated to settle within 1 year, such as creditors for goods purchased and unpaid utility expenses. Long-term liabilities represent money which the business owes and is obligated to settle within 1 year, such as a loan, to buy a motor vehicle or mortgage. Since we already know what capital is, we will dive deeper into it in terms of the balance sheet. Capital is increased by money or property contributed and any profits the business earns from operation, and is decreased by withdrawals made by the owner or lost by the business. Every transaction affects two accounts or items. One account is always debited and the other account is credited, which means that a balance sheet is always maintained in the records. We have come to an end of our second session. Please ensure to go over your learner guide